It's the most expensive way to live, and most people don't even realize they're paying the poverty tax. From overdraft fees to higher insurance premiums, the invisible costs of being broke add up to a staggering fortune over a decade. Let's do the real math on how much your bank account is actually leaking. You are taught that wealth is built through smart investments and high salaries. You are told that poverty is simply a lack of income. But this is a fundamental, dangerous misunderstanding of how the modern financial machine actually operates. Poverty is not just a state of having $0. It is an active, aggressive financial condition that financially penalizes you every single day. The system is meticulously designed to extract maximum profit from the most vulnerable participants, creating a relentless gravitational pull that keeps you trapped at the bottom. Today, we are going to expose the brutal, completely uncensored mechanics of the poverty tax. We will look at how banking algorithms silently drain your capital, how relying on physical cash has become a luxury you cannot afford, and how a cascade of tiny, invisible fees over a 10-year period can literally cost you the equivalent of a down payment on a house. By the time we finish calculating this 10-year real math, you will never look at a minimum bank balance the same way again. The financial system is not broken. It is functioning exactly as it was designed to. Welcome to the reality of the 2026 digital banking landscape. We no longer live in an era where a bank manager looks at your account and makes a human decision. Today, your entire financial existence is monitored, analyzed, and weaponized by highly sophisticated artificial intelligence algorithms that track your spending patterns in real time. These algorithms do not care about your personal struggles, your delayed paycheck, or your medical emergencies. They are programmed with one singular objective: to extract maximum yield from your account behavior. For wealthy clients, these algorithms offer premium wealth management, automated tax loss harvesting, and lucrative cashback rewards. But for the lower income brackets, these exact same AI systems act as predatory gatekeepers. They constantly scan your digital footprint, measuring your cash inflows against your historical spending velocity. They know exactly when your rent is due, they know when your utility bills will hit, and they can predict with terrifying accuracy the exact hour your account balance will reach its breaking point. This is the invisible battlefield where the modern poverty tax is silently collected, penny by penny, dollar by dollar, completely legally and without your explicit, conscious permission. The first and most brutal mechanism of this system is the instant penalty of low balances. In the past, you were only penalized if you actually overdrew your account, spending money you simply did not have. But the 2026 digital banking algorithms are vastly more aggressive. They utilize predictive maintenance fees. The moment your account balance dips below an AI-predicted safety threshold, even if you still have positive funds remaining, the system triggers an automated micro-penalty. The algorithm determines that your risk profile has temporarily increased, and it instantly levies a liquidity maintenance fee or a low balance service charge. You might have $50 left in your account, but because the AI predicts that your upcoming automated subscriptions will push you into the negative, it charges you $12 right now just to manage that anticipated risk. This creates a devastating, self-fulfilling prophecy. By charging you a fee because you are dangerously close to zero, the bank mathematically ensures that you will actually hit zero faster. If you are living paycheck to paycheck, keeping your balance hovering around $200, these automated threshold penalties can silently siphon away $40 to $50 every single month. Over the course of a single year, that is $600 completely wiped out. You are literally paying a premium subscription fee just for the privilege of being broke. But the algorithmic extraction does not stop at your digital banking portal. We must break down the massive surge in convenience charges for non-digital payments and the hidden access tax for using physical cash in an increasingly cashless society. As we march deeper into 2026, society has entirely optimized itself for seamless, frictionless digital transactions. Premium credit card users tap their phones and receive instant discounts, reward points, and zero-fee processing. However, if you are unbanked, underbanked, or simply relying on physical cash to physically control your spending, you are being aggressively penalized at every single turn. The access tax is everywhere. When you go to a modernized grocery store or a fast food restaurant, digital payments receive the standard pricing. But paying with physical cash often incurs a manual handling fee because the establishment wants to discourage physical tender. Furthermore, if you need to convert your physical cash into a digital format to pay your rent or utility bills online, you are forced to use third-party financial kiosks or prepaid debit cards. These services charge exorbitant reload fees, activation fees, and monthly maintenance fees. Every time you load $300 in cash onto a prepaid card to pay a digital bill, the kiosk takes a $5 processing cut. If you have to cash a physical payroll check at a local check cashing storefront because the algorithmic banking system denied your account application, you lose a devastating 3 to 5% of your total gross income instantly. The modern economy has made it incredibly expensive to hold, move, and spend your own physical money. Let us do the real math on this daily physical cash penalty. If an individual is forced to operate outside the premium digital banking tier, they are subjected to a constant barrage of micro-losses. Between check cashing fees, prepaid card reload fees, out-of-network ATM withdrawal charges, and manual cash handling surcharges at retail locations, a low-income earner can easily lose $40 a week simply trying to access and spend their own money. $40 a week equals roughly $160 a month. That is $1,920 every single year, completely evaporated into the ether. This is money that did not buy groceries, did not pay down debt, and certainly did not go into a high-yield savings account. It was simply the structural cost of existing at the bottom of the financial pyramid. When you combine this physical access tax with the digital low-balance penalties we discussed earlier, the average person living paycheck to paycheck is losing over $2,500 annually just in invisible structural poverty taxes. Now, we must transition from these daily agonizing micro-losses to the catastrophic, long-term, compounding impact of being denied standard credit rates. The banking algorithms that monitor your low balances and trigger maintenance fees are not just keeping that data internally. They are constantly feeding your financial behavior into massive, opaque credit bureaus. Every low balance penalty, every missed utility payment due to a frozen prepaid card, and every microloan you take out to cover a $30 deficit act as a massive red flag on your hidden digital profile. Because the system categorizes you as a high-risk, volatile consumer, you are systematically walled off from standard prime interest rates. This is where the poverty tax transitions from a daily annoyance into a lifelong, wealth-destroying prison. When a wealthy individual wants to buy a reliable used car to commute to work, they secure a loan at a pristine 5% interest rate. When the individual trapped in the algorithmic poverty cycle attempts to buy that exact same $10,000 used car, they are forced into the subprime lending market. Let us examine the devastating mathematics of this credit denial over a 5-year auto loan. The prime borrower finances $10,000 at 5% interest. Over 60 months, their monthly payment is roughly $188, and they pay a total of $1,300 in total interest. The subprime borrower, flagged by the system as high risk, is handed a predatory 22% interest rate for the exact same $10,000 car. Their monthly payment skyrockets to $276, and over the life of the 60-month loan, they will pay an absolutely staggering $6,500 in pure interest. For the exact same physical vehicle, the poor individual pays over $5,000 more, but the penalty does not stop at the auto loan, because insurance algorithms in 2026 heavily weigh your credit score to determine your risk of filing a claim. The subprime borrower is simultaneously hit with significantly higher auto insurance premiums. They might pay an extra $80 a month just for basic liability coverage, purely because their credit profile is damaged. Over 5 years, that is another $4,800 lost to the poverty tax. The compounding impact ripples through every single aspect of survival. When you have poor credit, you cannot secure a standard apartment lease without paying double or triple the standard security deposit. That is another $2,000 of your capital locked away, completely inaccessible and earning zero interest, while the landlord benefits from its liquidity. If you need a cell phone plan, you do not qualify for the standard postpaid contract. You are forced into prepaid plans that cost 20% more per gigabyte of data. If you need to buy a basic appliance like a refrigerator, you are locked out of 0% promotional financing and forced into rent-to-own agreements where a $500 appliance ultimately costs you $1,400 over 2 years of weekly payments. The invisible fees are everywhere, compounding on top of one another, suffocating any attempt to save or invest. The individual is not failing because they are irresponsible. They are failing because the structural friction of the system requires them to run a marathon while wearing a 100-pound vest of financial penalties. Let us pull all of these terrifying numbers together and look at the 10-year real math. Over a single decade, the algorithmic low balance penalties and digital banking fees drain approximately $6,000. The physical cash access tax, including prepaid cards and check cashing fees, extracts another $19,200. The subprime auto loan interest penalty robs you of $5,000, and the inflated auto insurance premiums drain another $9,600. The inflated deposits, rent-to-own markups, and prepaid utility premiums easily consume another $10,000 over 10 years. When you calculate the raw, brutal mathematics of the poverty tax over a 10-year period, the average low-income individual pays nearly $50,000 in completely invisible structural fees. That is $50,000 of their hard-earned labor that was systematically extracted by banking algorithms, subprime lenders, and corporate risk models. But the absolute most devastating part of this 10-year calculation is not just the $50,000 that was lost. It is the massive, compounding opportunity cost of what that money could have become. If that $50,000 had not been stolen by the poverty tax and had instead been steadily invested in a basic, globally diversified index fund, returning an average of 8% a year, it would have grown to over $75,000 by the end of the decade. That is the true, horrifying cost of being poor. It is not just the money you are forced to pay today. It is the massive generational wealth you are mathematically prevented from building for tomorrow. The system ensures that your capital is perpetually drained before it ever has a single chance to compound. You are kept running on a high-speed, high-stress treadmill, terrified of the next algorithmic penalty, while the banking institutions use your extracted fees to pay out lucrative dividends to the people who are already wealthy. Breaking free from this aggressively engineered, deeply entrenched financial prison requires an almost superhuman level of discipline and extreme, radical behavioral changes. You must deeply understand that the modern banking algorithms are actively working against your survival. You have to violently restructure your life to avoid these algorithmic traps. You must completely consolidate your remaining capital to permanently escape the low balance penalty threshold, even if it means ruthlessly cutting your basic caloric intake or living in extreme discomfort for a short period of time. You have to aggressively transition entirely into the digital banking ecosystem, securing a no-fee digital checking account to permanently bypass the devastating physical cash access tax. You must treat your credit score not just as a number, but as an absolute matter of life and death, aggressively avoiding any predatory microloans or high-interest revolving credit that will permanently brand you as a high-risk consumer. The poverty tax is the most expensive luxury in the entire world, and the only way to stop paying it is to recognize the invisible battlefield you are standing on. You are playing a rigged financial game against advanced artificial intelligence and deeply entrenched corporate structures. You cannot win by playing by their rules. You can only win by recognizing the traps, protecting every single penny from algorithmic extraction, and ruthlessly forcing your way into the financial safe zones. The real math does not lie, and the clock is always ticking. Choose your next financial move incredibly wisely, because the algorithm is always watching, always calculating, and always waiting for your balance to drop.